Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. Just like in the stock market, greater uncertainty has led to swings in the bond market. These moves, driven by tariffs and a dispute between the White House and the Fed, have pushed interest rates and bond yields higher. While short term volatility can often lead to unexpected results, it's important to remember that periods like these occur periodically, even if the causes are different each time. For bond investors, especially those who rely on their portfolios for income, the current environment may present both challenges and opportunities for their financial plans. The bond market has been volatile. One of the key principles of portfolio diversification is the idea that stocks and bonds are typically uncorrelated. That is, when stocks move one way, bonds tend to move another way. This is not by accident. Stocks tend to perform well when the economy is strong, whereas bonds have historically performed well during periods of economic uncertainty. This is why combining stocks, bonds, and other asset classes can result in a portfolio that is more stable than holding a single asset class alone, improving the odds of achieving financial goals. So, what is happening in the bond market and why does it matter? There can be periods of financial market volatility that create exceptions to these historical patterns for short periods. For instance, bond volatility can occur when markets adjust to significant economic or policy changes, such as the ones taking place today around tariffs and the independence of Fed policymaking. When it comes to tariffs, bond investors are weighing two possibly conflicting scenarios. Trade wars could raise prices, which would be inflationary, usually negative for bonds, and or they might slow economic growth, usually positive for bonds. Bond prices are highly dependent not only on where interest rates and the economy are headed, but also on how uncertain this path might be. Just as recent government moves around trade have made it harder for households and businesses to plan for the future, so too is it harder to forecast where economic variables might be in a few months, let alone in a year. This includes the direction of Fed policy, which is exacerbated by the headlines surrounding President Trump and Fed Chair Powell. Thus, it's not surprising that bond prices have fluctuated alongside stocks. Bonds have still helped to stabilize portfolios this year. Of course, some perspective is needed. The 10-year Treasury yield is currently around 4.3%, well within its range over the past 2 years. In general, interest rates are higher than many investors expected at the start of the year. Despite this, most bond sectors are still showing positive year-to-date returns, including the U.S. Aggregate Bond Index, Treasuries, and investment-grade corporate bonds. As demonstrated by these returns, corporate bond investors are differentiating between higher and lower quality issuers as economic uncertainty persists. Corporate bond spreads, which show how much yield these bonds generate versus treasuries, are one way to measure this. Investment-grade spreads have remained fairly tight, while high-yield spreads have widened considerably. Municipal bonds have also faced greater volatility in recent weeks. The muni ratio, which compares municipal bond yields to treasury yields, jumped on the tariff announcement and remains elevated. The higher ratio means that munis are more attractive today compared to treasuries, particularly for investors in higher tax brackets and in high tax states. Bond yields continue to be attractive. Regardless of how bond prices move in the coming weeks, bond yields remain attractive compared to the past 2 decades, creating opportunities across the bond market for those who need portfolio income. Investment-grade corporate bonds, for instance, currently have an average yield of 5.3% compared to an average of 3.8% since 2009. The case for bonds may also be favorable since the Fed is expected to cut rates again later this year, regardless of how the dispute with the White House plays out. For income-focused investors, current yields are attractive across many fixed income sectors and can help support portfolios amid ongoing uncertainty. The bottom line, policy headlines continue to rattle financial markets. While bonds have been volatile in recent weeks, attractive yields and still healthy returns can help long-term investors achieve financial goals. Thank you for listening. For additional information, please visit mraadvisory.com.